Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chris McGratty, Head of U.S. Bank Research at KBW, to discuss why his team recently took its rating up on U.S. banks to overweight. We'll also take a look at large cap bank ETF that offers exposure to the group. Chris, it's great to have you with us. Welcome to Trade Talks.
Great, thanks for having me.
Chris, what was your call on the banks prior to the upgrade a couple of weeks ago, and what types of banks are in your universe coverage?
Yeah, so our call on the group to start the year was we wanted investors to own the largest banks. We thought they offered the greatest earnings upside from normalizing credit as the economy got back on its feet. We also thought the capital return story was quite compelling. And then you align that with the discounted valuation. So we thought investors would be best suited to go up the cap in terms of the banks.
Why upgrade now, and what's changed?
Yeah, so what we've seen, it's actually been a good call. The largest banks have delivered on the fundamentals that we thought would occur, and the stock performance has been quite strong. Very meaningful outperformance compared to the S&P 500. But what was interesting to us, Jill, is during this last 6 months, the smaller banks, the small mid-cap banks, they peaked in terms of their relative performance in March. And since then, we've seen bond yields collapse. We've seen sentiment towards the space wane. And the smallest banks have underperformed the most. So this was, in many ways, a bit of a catch-up trade to own the smaller banks.
And you also updated 7 banks to outperform. What are your top ideas?
Sure, yeah, that's right. Seven banks. 5 of them I cover directly. I would say the underlying hinting of the thesis was we liked optionality. We like the optionality from loan growth inflecting, and we're seeing signs of that in the Fed data. We like the optionality from higher interest rates. Even though rates have come down, we still think the longer term move is up. We like the optionality that the banks offer from redeploying all this liquidity that's sitting on their balance sheet. And then again, the sentiment and valuation we thought were pretty attractive. So within my space, we upgraded companies like Comerica and Zions Bank, very rate sensitive, a ton of cash on their balance sheet, and very inexpensive valuations. At the other end, we upgraded a company, SVB Financial, one of the, I would say, premier companies in the country, very asset sensitive, very growthy in a non-growth industry, and the valuation again had pulled back a bit.
Where are you less constructive, and what's the risk to your thesis?
Yeah, I mean, I would just say the opposite of why we like the group is the reasons we would be a little more cautious on banks in the other side of the spectrum. You know, these are banks with less optionality from higher interest rates. Perhaps they've already deployed a significant piece of their liquidity. Perhaps they have a history of not delivering loan growth when the market demands it. And then there's also these idiosyncratic risks, such as derivative running off, and so the earnings pressures there. And then you also have to consider the valuations. Many of these companies trade a little more expensive, and if the fundamentals are going perhaps not as strong as the others, we would be a little bit more cautious there.
Investors can get exposure to the group through the KBW ETF, which tracks the KBW Nasdaq Bank Index. What differentiates it from other bank ETFs?
Sure, you know, our quant team has done some tremendous work on the ETFs. The KBWB is the only pure play large cap bank ETF in the market. What it does is it gives investors exposure to 24 leading banks without the exposure to the mid caps or mortgage finance companies, which some of the competitive products do offer. The BKX, which is the index behind the KBWB, has a really long history amongst bank indices. Its history goes back to 1993. And we think this, the purity of this index in this ETF has supported the AUM growth that we've seen over the last few months.
All right, Chris, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.